Good afternoon, everybody, and welcome to another edition of Between the Lines Live. My name is Vanessa Rader. I'm the Head of Research at Ray Wyatt Group, and I'm joined today by a great panel because we're going to talk about some fun things today. We're going to talk about pubs. So we've got Andrew Jolliffe. Andrew's actually been on before, so welcome to Andrew.
Thank you.
He's the Managing Director of HTL Property. And we've got James Smithers, and James is the National Director of HTL Investment Management. So welcome.
Thanks for having us.
Thank you.
Welcome. So the pub sector is probably, it's just a really interesting asset class. It's probably a lot of people don't understand how big the asset class is in terms of value and activity that goes on. To give you some kind of concept for those who don't know, peaking in activity, just even here in New South Wales, over $2 billion worth of investment activity. But just like all the other asset classes around, the commercial asset classes, we did see listings drop off 2023 with the financing and funding availability there, about 1.1 in New South Wales. So let's take a look at where we are, where have we landed this year, and so where are we at today for the pub sector?
Yeah, so I think if we think about 2022 as a calendar year, I think you're right that was the peak of the asset class in terms of transaction volume, so the number of transactions. So I think there was over 100 hotels sold in New South Wales alone. And as you say, you know, the peak of the basket size of the value of those pubs was also at its absolute Everest at that in that particular year. 23, along with a whole range of asset classes, was obviously lower, and for two reasons: fundamentally driven by the interest rate rises, which meant that the debt liquidity was less accessible, not as accessible financially, but also just in terms of the physical liquidity of it. Banks took a bit of a different view, and there was a change in the cadence of the investor behaviour. That was one reason why there's a difference between 22 and 23. The other is when you have a peak or a record year, they're hard to replicate. We're in 24 now, clearly, and almost at the halfway mark. And our sense is that it'll be somewhere between the highs, of 22 and where 23 finished. So up on 23, probably not where 22 was, but certainly bouncing back, very well after a softer year last year.
And how about is there any kind of demand in certain locations? Is it kind of like a coastal thing? Because I remember in 2022, you had a number of record deals that occurred that year. Quite a lot of interest in those kind of regional markets and also the coastal markets, particularly off the back of COVID and lockdowns and things like that. Is there any sort of change, anything kind of obvious that's happening in the market today, or is it kind of listing driven?
Look, it is a bit listing driven, although you've sort of caused me to think about that in a geographical sense, and probably that whole regional activity, coastal activity that did take place in 22 and 23 is still absolutely a feature. In fact, very proudly, I think we might have set the record again in this last week in terms of a regional asset, which we'll disclose in the next week or so. But there probably has been a greater proportion of metro assets sold in 24 by comparison to the percentages of the others. And again, look, there's pubs, are a finite resource, a finite asset class. So, sort of selling 100 in one year and selling 50 on the next year, there's only so much that can change hands. So I think we did quite a lot as not only as HTL but as an industry. We actually did quite a lot of work in terms of transactions, in regional and coastal areas in 22 and 23. So that might just mark time a little bit this year, and we'll see. Those assets often sell better towards the end of the year, particularly the coastal ones, obviously. So We'll see what happens.
Starts getting warmer, everyone wants to go out.
Yeah.
Have something to eat, something to drink.
Yeah.
And in terms of who is buying these, I know we've spoken about this in the past, is these generational assets, a lot of families involved. Is that still the case? Is that who's transacting? Absolutely.
Generational families or experienced, private groups are still right at the very vanguard of who's actually buying hotels. But as is often the case, some sophisticated investors, some offshore, some domestic, have taken a real interest in the space, and we've seen some huge transactions in that regard. We saw KKR replaced by PAG in the AVC model to the tune of $1 billion or thereabouts. So we've seen a lot of actually, some high-level sophisticated transactions going on, and James sees those, but that'll continue.
Yeah, so we're seeing that maybe 2024, and even beyond, there could be kind of a more sophistication perhaps added to the kind of investment. So what sort of, who are you dealing with, and what's their interest in the pub market?
Yeah, so primarily we're dealing at the moment with the alternative funds that are looking for a bit more value. Post-COVID, obviously, the real estate market has been quite choppy, and what we've sort of seen in the downturn in offices, you know, people looking further afield for value. So it's taken a little bit of time, but pubs essentially have been an asset class where people have misunderstood, I think, the true essence of what we deliver. So, you know, you have 5 revenue streams across food, beverage, gaming, accommodation and retail. And when you look at those offshore, you know, funders, they are typically investing in asset classes that have 1 or 2 revenue streams. So here in Australia, having 5 is something that's very, very unique to our market. And I think what we've sort of seen over the years with the Vardays, the Yorks, the Molduses coming into the asset class, once they tend to get in, they do tend to stay. We have seen a little bit of late that dislocation not playing out as we would have expected post-COVID, and what actually happened was yields sort of compressed and went the other way. We sort of felt there'd be some dislocation, there'd be some value buying, and we were sort of over the years dealing with a variety of variety of investors that were trying to get into the asset class. So I think we're at that point in the market now where we're sort of shifting back to that. We've sort of seen through interest rates, cap rates begin to widen a little bit, but to Mark sort of Andrew's point, it's very hard for there to be continuous transactions when there's just not the value in other asset classes. So, you know, if you exit a hotel today for X number of millions, you've got to find somewhere else to place that money and get the same level of yield. And, you know, it's just very tight with real estate, with cash flow back real estate. There's just not that much opportunity at the moment. So I think what we're seeing is that there is a real pent-up demand for foreign investors that are looking for not just yield, but equally safe harbour. There's obviously still a war happening in Eastern Europe, tensions across the South China Sea. So there are groups throughout the UK, Europe, and also Singapore and Hong Kong that are looking for, you know, safe harbour, consistent returns. And given that we tend to be quite centric from a political standpoint, you know, we're a great place to park passively and attract and obviously, you know, generate yield. So look, what our sort of, I suppose, complementary piece to the property division is obviously assisting institutional investors come to market, but equally some of the families and the syndications that need a bit more assistance either leading into the sale process, assistance at looking at how they can better service their venues, their operations, and essentially just as the industry, I suppose, moves away from being a little bit sort of cottage to being a bit more professionalised. They need a little bit more, I suppose, you know, detail in getting themselves into a better position. So we obviously are quite holistic in how we sort of think about assets, and obviously to your point, geography is important, but at the end of the day, these are, you know, businesses driven by human capital, and we service that through just the depth of our industry contacts.
Well, foreign investment into Australian commercial property is nothing new, and we know, particularly the big end of town with retail and office, that's always been, everyone's loved that kind of safe haven, as you said. You know, location of Sydney, it's always kind of a good place to kind of park your funds. It's kind of, it's seen that way. But I hadn't really thought of it from that. Those kind of 5 income streams, like you mentioned, if you think about it, like I've never looked at it that way, but you're absolutely right. And in being able to diversify in terms of getting your income from all those different kind of revenue sources is absolutely awesome for those investors, and that's probably why they're looking towards it.
Yeah, I think what we're sort of noticing at the moment, and AJ can obviously talk to this, is that traditionally what we've sort of seen here is the groups that have been very good at optimising 2, potentially 3 revenue streams. And accommodation, retail, at times it's been food, at times it's been the beverage offering. They just haven't really been, you know, executed to a standard that is good enough to drive footfall. So we've had a charmed run, obviously through real estate, CAGR of gaming from 20 12 to 19 was a bit over 7%. We've seen that normalise back to the same levels post-COVID. So the high floor of the space is, it's really exceptional. And at a, for foreign investors or even domestic investors that are looking to come in, the high cash flow generation is really just, second to none. So I think the opportunity now for those more sophisticated investors, or even for the families that are looking to get more out of their asset, it's how to optimise the 5 revenue streams rather than just 2 or 3. And I think that there is still significant opportunity in the space to do that.
But how about like the size of the assets? Like there are some big pubs, and like I said, we've broken some records in the last little while in terms of value. But when we think of kind of big international investors into the country, they're often looking at like office buildings in town, which could be up to $1 billion. Like you said, there's only so much pub assets that we do have in Australia, and they probably are they at a price point that's attractive to them, or is it make it more difficult, or is there?
I think the problem we have at the moment is when firms or groups come in, they have an expectation on check size. So for a group to come in and they want to spend $500 or $600 billion, and they're prepared to do that on 2 or 3 revenue streams. It's fascinating to us that we look at a holistic offering from 5 revenue streams, and we feel that optimising that probably gets to that level. But it's hard to get the scale, and I think it sort of comes back to Andrew's point on finding the best way to dislodge or dislocate these transactions. It's getting harder because it's harder to get this cash flow elsewhere. So, I think the next 12 or 18 months. Obviously, there's a lot of discussion around discretionary spending. I think what we're seeing in the market is more a case of substituting. I think consumers are still going out. They're absolutely enjoying themselves, but they're going to better venues. They're going for the experience, or they're going for value. Right. So when consumers are making those choices, those venues or those groups that have optimised 3, 4, 5 of those revenue streams rather than 1 or 2, that's where footfall was flowing. And I think, our advice obviously is, look, if you've got 5 revenue streams or 4 revenue streams, they need to all be optimised. But it's imperative in a tight market to continue to elevate those standards. And obviously we pride ourselves on an operating level in doing that. But I think where we sit is the next 12 to 18 months, we will see that trend continue until there is a rate cut at some stage next year. But I think what we can sort of definitely take a view on is that if you are coming into this asset class towards the back end of this year, early next year, I think we'll see cap rate compression.
Yeah, well, that brings me to the next question I was going to ask. So, AJ, like we said, the cap rate compression, or the kind of the change in cap rates, has been probably not as obvious compared to a lot of different asset classes, commercial asset classes. Well, a lot of commercial asset classes definitely doing it tough at the moment. Not a lot of stuff on the market. Well, there is assets on the market, but only if they really need to be on the market. A lot of kind of sitting and waiting and seeing, sitting on your hands, not really doing things. Yeah. Where have yields kind of sat in that pub space, and where are we today compared to, say, those kind of peak times in the market?
Look, I think yields move pari passu with cost of debt, with interest rates, and like all asset classes, the hospitality, tourism, leisure, whether it be pubs or accommodation venues, they've softened in line with that. But as you say, not to the extent that other asset classes have. And I think fundamentally because pubs are a good bet. They're a good bet for a bank. They have hugely prosperous cash flows and the serviceability is far greater than maybe another passive interest in a commercial office building or something where the revenue is reasonably static, but for annual indexing, there's not much you can do to improve that. If the cost of your debt goes up, you're kind of stuck. You're in a bit of a pincer movement there, but you can actually influence revenue, therefore profitability in a pub. And so I think that aspect means they're an attractive asset class for lenders, which is particularly important, obviously. And to James's point, for sophisticated groups, offshore groups, they look at it and they say, well, can we get scale here? And we've got $100+ million pubs individually now. We've sold a few, and there are a lot more out there. So we're an asset class that has got a bit of firepower now.
Yes. in terms
of the size of the check that can be sent our way. In terms of those yield, look, like James, I think there's more discussion around downward pressure on rates, albeit maybe, protracted, and maybe it's next year. I'm still not convinced it's next year. Actually, I've still got a feeling that it might be this year, and also I hope that it might be this year. But I actually think it will be, and that is breeds really positive sentiment. That in and of itself will contract yields. But we saw in the Fin Review today, I think it was Andrew Pridham, from Moelis, commenting about the asset class more broadly and saying, well, this is a particularly interesting time for investors. If you're trying to pick the top or the bottom of anything, it's normally pretty tricky. 5% or 10% either side's not a bad effort. So he's advocating, as I understand his article today, he's advocating for this to be a really great time. And let's see, post 1 July, some stage 3 tax cuts. That'll be, I think, very helpful to a lot of people, and some people will use that, those tax cuts to provide themselves with a form of entertainment, like James is talking about, better quality, or maybe you're staying domestically and you're not going away, and then we've got an asset class that can facilitate, those sort of family experiences.
Yeah, it's certainly. I really haven't thought of those kind of 5 income streams, and I suppose some of those really good high quality assets that you talk about, they probably are good examples of ones that do some of that well, that could probably always do better, but maybe not across all 5. But being able to get that secret source right, I suppose, and getting a really profitable business.
It also helps you elongate trading hours too, right? So we've got these buildings, and you think about any commercial property holding, how do you actually get maximum, extract maximum value out of it, and that is the utilisation of the facility. Pubs used to trade for very limited hours, really, for what they were. We've talked about this on previous discussions we've had, Vanessa, about them being on a high street, on a corner, very prominent, typically a good land holding, multiple use, maybe surplus, development use. So they're in good positions. Typically, pubs are, it's not a coincidence, they're on the high street and they're in a good position. But how do you actually elongate the trading hours so that you bring people in, so that you've got more revenue coming in over a greater period? And to do that, you've got to augment the number of revenue streams. You've got to have, you've got to talk to those markets, those earlier in the day markets. And so the good ones that we've referred to have been able to do that. So they've got very strong food, they've got very strong, obviously, beverage, but they've thought about accommodation. How do we intersect with other parts of the community here? That just means that we've got more people over a greater period.
So we kind of spoke about what the future of these assets are, but it's quite interesting, and I'm sure a lot of our viewers probably haven't thought of pubs. They just think of the corner location down their high street. But how about things? We've got these international visitors or international investors, coming in. Where do issues such as like ESG and all the compliance and stuff, does that kind of factor more than we probably haven't thought about it before, when it's been a very heavy private investor market?
Look, I think it's shifting, and I think what we have to sort of realise as well is that on the ESG side, when it comes to the E and the G, I would challenge most to find a more advanced industry than where we currently sit. On the governance piece, it is an incredibly tightly regulated industry, and the way that the governments across obviously Queensland, New South Wales and Victoria have been managing and integrating the gaming piece, and again you have to separate pubs from clubs and from casinos, because they're essentially 3 very, very different models, albeit service orientated, but the way that gaming is driven within pubs is incredibly regulated. So I think when people get, and again this comes from people from abroad, they take a view that these are mini casinos, or that and it's not what it is. What we sort of stand behind is the governance piece is incredibly robust. The environmental piece, given to AJ's point, the large footprints, there's been a huge shift given electricity prices to run these sorts of assets into solar, and I would say that pubs are very, very progressive on the E and the G side. I think where we are now working towards is the S piece, and that societal piece, or that social piece, is really going to be about how pubs, given their location and being in transport nodes and high streets, I think where we're going to head is a lot more mixed use, and we're going to see pubs being incorporated into development. Now, the article that Andrew referred to earlier around build to rents, and we are sadly still quite cost prohibitive here.
Yes.
And there does need to be some sensible reform around that piece, because that will alleviate a great deal of housing issues. And I think pubs, sit, with this amazing ability to say, well, look, within our per square meterage over a ground and a first floor, we can get enough value out of that to allow that industry to continue and to thrive. But the airspace above that, we really do need to do more. And I think in doing that and embracing that, I think we will offset a great deal of the imbalance that we currently see within the space. And I think there are a lot of operators out there that have transitioned to food and to being more well-rounded, to AJ's point. And I think that's imperative to continue, because in doing that, we as an industry continue to, not just elevate our standards for the guest and improve the guest experience, but we start to erode some of those ESG concerns that casinos or clubs have obviously worked through or currently working through, but we have not been a part of. And I think that's the important distinction, is that pubs have been incredibly well run by these families and syndications for the last 20 odd years, and I don't see any amendment to that. But I think that we can certainly shift with society a lot quicker. Some of those groups are shifting in line with those views, and I think they will be the ones that will continue to thrive in this market. But I think the value to the space overall through mixed-use development, it just unlocks another.
I tend to agree. Like you said, they're in high street locations, so they're transportation. They're on large footprints, on corner locations, and like you said, the airspace or the air rights above. Like, there's so much opportunity to be able to do that, and we kind of need to do it because in our kind of, particularly in our metropolitan areas, we only have so much land. We've got such a housing stress at the moment. So anything to kind of do that. And have you had many of your investors do they have that? Well, I'm sure they do. They have that forward-looking kind of plan and think around that when they're looking at investing. Yeah,
definitely. And I think you think about part of the reason that pubs are on these big footprints is because they used to attract lots of people who would drive to them. Less and less people are driving to pubs for a whole range of reasons, mainly because the transport's now so good, but there was a period there where the transport wasn't great, but RBTs and the introduction of that, changed the way people interacted with their local pubs. So you don't need all those car parks, so maybe that sort of, the state government's actually doing quite an interesting job here at the moment, thinking about some of these areas, fringe areas, and how might we better serve the undersupply in housing that we've got.
And just a local community with retail offerings or, all-day food offerings. I'm not sure what it is, but that's, be part of the community.
It's an important conversation, because I think, in terms of where we're heading, these assets become precincts. And they're precincts not just for people to consume alcohol on a Friday, Saturday night. And that as a business model, we've seen that shift away. We're, as a society now, we're much more health conscious. And in most LGAs, there's more gyms than there are pubs. So I think publicans are starting to learn that they need to be more universal in how they utilise that footprint. And if they look at their per square metre, EBITDA, I think they're going to start to work out, okay, well, we need to reposition this, we need to think about this a bit differently. It doesn't change the essence of the model, we're still service-driven, but to Andrew's point, I think we can be better in how we sort of approach that next phase. And there's no question that how we view development moving forward is going to be critical.
Well, that's the other thing. Like, we mentioned that there's only so many pub assets. So can we develop new pub assets? Is there... our population is growing, and particularly in kind of those greenfield locations, perhaps around any of the cities, really. Is there more development going on that we maybe don't know about?
Sure. Look, the greenfield pub developments are still a real thing, and we were involved in a transaction the other day on one. So, it's still a thing. As James alluded to, though, we are so heavily regulated that a lot of the regulation around state government regulation in terms of the Liquor Authority, local government in terms of council and planning, hugely regulated. So the hurdles to jump over to actually deliver a greenfield site, leave aside the cost of the thing in a world where construction is expensive, where the scarcity of one of those revenue streams James referred to is gaming and responsible gaming offering. physically going and getting those
Yeah, it's
30
difficult.
machines, very hard to get.
Yeah.
They're very expensive. So putting all that together means that they're less common, unfortunately, but they're absolutely still happening. But that, and I think we've touched on this before previously, in and of itself, that's the barriers to I guess the hurdles to create new pubs is also the barriers to entry for existing pubs, which is why they're seen as a strong investment thesis, because you're unable to turn up next to the pub on the high street with a new pub and take the trade away.
Yeah.
Importantly.
Yeah, no, that high street piece is, that's what most people kind of think of.
Yeah.
But you're right, and those larger kind of greenfield developments, if they can get off the ground, I suppose they might be ones that a lot of your offshore buyers might be interested in. But I think, can I just circle back quickly to the poker machine entitlement? So
Sure.
a lot of people probably don't understand that isn't an endless supply of poker machines.
No.
That continues to decrease rather than
Correct.
increase. So if you did have a new establishment,
Yeah.
how hard is it to get those 30 machines?
Quite difficult. You've got to go on market and buy them from someone who's willing to sell them. So there's a market there, and we participate in that as a broker. But there is a supply demand equation that exists there. It's difficult to get.
And you can't just move them out of one area into
There's-
another easy. Like there's a whole, like I said, it's very highly regulated.
highly
it's very
regulated,
difficult,
and there's
inexpensive.
forfeiture exists, which means that you've got to sell them in a group of three, and you forfeit one back to the government, which is the government's way of minimising the number of them. And as you say, there are less of them today than there were this time last year, and there'll be less again in a year's time. The Mins government has said in New South Wales it'll actually expedite the contraction from 3 to 1 to 2 to 1. So
right.
it's going to exacerbate that quite dramatically. It's interesting to think about what that might do to the value of PMEs if there's less of them, but it certainly makes them harder to transport around, which then becomes a mitigant to greenfields. So
Yeah, that's certainly an interesting time.
Yeah, I think just to add to that, I think it really underpins our thesis in terms of the resilience of trade. We have consumers in these areas that are getting increasingly populated. We've had great earnings due to the population growth of Western Sydney. To not be able to service those demographics, I think is a shame.
And so when your investors, this is for both of you, they're looking at those population projections to really kind of cement where they're looking to purchase. So I'm assuming kind of Eastern Seaboard is always kind of the best recipe, or am I just being Sydney snob? Or
Look at this time in the market. I mean, Sydney and Brisbane equally are getting a great deal of attention.
your volumes have always been quite high in those two markets.
Yeah, there's, I would say 7 out of every 10 inquiries are built around Brisbane and Sydney. I think what we're sort of seeing in terms of within those LGAs, investors are agnostic. It really is about return. They're quite comfortable with the asset class. A number of groups have worked their way through ESG, and they're quite comfortable that, given the government affiliation, that we're well regulated, and as long as we're well managed and there's a track record, then that tends to suffice. But I think what we're sort of looking forward to is the next sort of 6 to 12 months will be an interesting time in our space. I think we will start to see more entrants come in. I think assets will be more keenly contested, and we're excited to work through that development phase as well, because I think what we all want is a high delivering industry, and more groups that are investing back into those communities and elevating their standards, and I think that is what is currently happening.
Wow. Well, certainly an exciting time for the pub sector, and only really, like I said, greater sophistication. We're going to see more entrants in the market, and stay tuned, because your local pub is going to offer lots of things, and hopefully be a hive for activity and be more development going on, which is a great news story for you guys and for the community
Sure
as a
is.
whole.
Yeah.
So thank you. So I think that brings us to the end of our chat. So thanks so much to AJ and to James for coming and chatting to us from HCL Property. It's always so interesting to understand the pub market. It's one that not everyone talks about all the time, but it is such a robust market, and so much activity going on there. So thanks so much. And everybody, thank you for joining in. The information for next Between the Lines Live will come out shortly, but I'm going to be heading over to Perth, so talking about all things Perth in the commercial sectors. So I'd stay tuned for that one there. And as always, this will be available on Spotify probably tomorrow, so you can always listen to that and listen back to all of our previous ones as well. So thanks for joining us, and we'll see you next time. Thanks, guys.
Thank you.
Thank you.